Hello, and welcome to the 12th episode of Raising Capital 101. I'm Tom Voekler, and I'm joined today by Chip Cunningham and Rhys James, and we're going to discuss the basics about the 40 Act and how that relates to private funds. Chip, what is this thing called the 40 Act?
So the 40 Act seeks to regulate companies' funds that are primarily invested in investment securities. It's a more cumbersome regulatory apparatus for those companies because of the perceived risks of holding investment securities. And so it brings with it a special type of federal registration and compliance that again is pretty onerous. So you don't want to step into it unknowingly. A mutual fund, that's the classic example of a company that's registered and regulated under the 40 Act. And if you're getting into the mutual fund business, you know that you're going to be subject to the 40 Act. The issue is that the term investment security is very broad and potentially captures a wide array of funds that don't intend to be regulated by the 40 Act and for whom 40 Act regulation would be incompatible with the business plan and strategy of those funds.
I'm assuming if you're subject to the 40 Act, there is a lot of governance and a lot of cost and a lot of time associated with that.
Yeah, absolutely. It's a very specialized area of securities compliance.
So we probably spend the majority of our time trying to stay out of the 40 Act or find exemptions to that. So Rhys, why does the 40 Act matter when we're kind of in the private fund context?
Sure. Well, first and foremost, it matters in structuring how your fund is going to raise capital and what it's going to do with that capital. Because if you fall into the business plans that require 40 Act registration, then there are limited exemptions that would allow you to avoid it. For example, exemptions related to having only 100 or less beneficial owners of your securities, or having all your securities issued by your fund being owned by qualified purchasers, which are generally folks with over $5 million of liquid net worth, or you have real estate funds, which invest under an exemption called 3C5C into interests in real estate, which is bricks and sticks or interest in mortgages and related assets. So when you're trying to avoid that compliance, you're first thinking about how you're going to structure what you're investing in. Then you're doing that because there are elements of the 40 Act, in addition to reporting and compliance, that may not work with how you want to run your business. For example, leverage limitations, or get compensated as the manager of the fund.
Yeah, that's great. So Chip, like you said, investing in securities, we hear about a lot of hedge funds that are investing in other funds or doing things like that. What do they rely on to kind of stay out of the 40 Act? What are the two major exemptions that they kind of use together a lot of times?
Yeah, if somebody is actually in the investment securities business, it's either 3C1 or 3C7, and sometimes you see them operated in tandem between two related funds. A smaller, call it retail-oriented fund for the 3C1 because it's limited to the 100 security holders, and then the larger institutional side being the 3C7. And again, they're clearly investing in investment securities, but what the Investment Company Act, the 40 Act has done is said, 3C1, that's so small, we're not going to be concerned about that as long as you limit yourself. And there are very detailed rules about ownership attribution. So funds are not trying to end run the limits there, that the 40 Act won't regulate a 3C1 fund. And then on the 3C7 side, it's, well, these folks have such a net worth or a wealth of investments or of a certain institutional nature that they don't need the protections that we otherwise think investors in 40 Act companies would need.
The last one you talked about was 3C5C, and a lot of people just kind of affectionately call it, the real estate exemption. Can you go into a little more detail about what you have to invest in what are maybe some problematic investments, and are there like percentages, or what do you have to deal with there?
First and foremost is to recognize that if I'm a fund and I'm investing directly or through wholly owned subs into real estate, and all I'm investing in is dirt, I probably don't even get to the analysis of the exemption because I'm probably not falling into the definition of investment company in the first place. But 3C, 5C exists for funds that invest in interest in real estate, which a lot of those interests could be investment securities as otherwise defined in the 40 Act. Examples like secured notes, mezzanine notes, other types of real estate related securities that are interests in real estate. And so the commission, the SEC, has developed through a long series of releases and no action letters a set of percentage boxes that a fund that is going to claim the 3C, 5C exemption has to fit into, some of which have to be sort of the closest to real estate that you can think of. So certainly actual direct ownership, mortgages that are 100% secured would be in that, qualified assets basket. Then there's, other interests in real estate have their own basket. On the other hand, there's certain interests in real estate that are securities that probably wouldn't fit inside of something that's safe for the exemption. For example, if you own REIT stock or non-voting preferred equity in a joint venture, things where you're not really acting as an owner of real estate or a secured lender secured by real estate, they're going to likely get excluded, even though some may argue that they're an interest in real estate.
So you really want to control the actual real estate asset, right? I mean, you want to have management control, ownership control, something along those lines.
That's right, Tom. Ultimately, control is a very good indicator as to where the commission's going to come down.
So, Chip, how does that work if you've got a lender who comes in and says, that's fine, but I don't want a loan to the fund. I want a loan on a specific property, and I want it in its own little entity, its own, limited partnership or limited liability company. How does that work?
Yeah, so if the concern is is the lender going to raise an issue like a mortgage REIT, making a loan to that entity and it's secured by that entity, there is SEC discussion that if you follow a certain layer of rules for mezzanine loans, that'll be treated as a good 40 Act asset. If you're outside of that, then you would have to treat that as a bad asset or maybe a real estate related asset, but it wouldn't be a good asset counted towards that 55% bucket.
Chip, we're not really going to talk about the Investment Advisors Act, which is another thing we work hard to keep our clients out of, just like the 40 Act. But what is the interplay here? Why do we really want to get kind of into into the real estate exemption? Because a lot of our interest, a lot of our clients want performance-based fees or carried interest, things like that.
Yeah, so even though you may be exempt from the Investment Company Act, particularly with 3C1 and 3C7, you still may have a manager or advisor to the fund that's essentially advising on investment securities. And that's not a Investment Company Act issue. It's another 40 Act, the Advisors Act of 1940, that requires that manager to potentially register or otherwise find some exemption from registration as an advisor. And you don't tend to have that on the 3C, 5C side because the portfolio that the 3C, 5C entity is holding isn't considered a securities portfolio because of how the buckets work out. It's possible, but most 3C, 5Cs that are true real estate funds don't have that issue, and so you don't have the advisor or manager of that 3C, 5C needing to go out and register or deal with investment advisor exemptions. And when you do have an investment advisor registration issue, that's when you get into needing to look at the investors in that fund. And there are limits on the ability to charge performance-based fees, carried interest being a classic example of that, on the accounts for those particular investors. Those are what are referred to as qualified clients. And I know that that's probably a topic for another day, but certainly you need to think about that when you're thinking about these Investment Company Act exemptions, that they're not necessarily solving all the compliance issues.
Yeah, no, I think that's great. I think that's going to wrap up today's discussion. I think it makes clear that when we are structuring and, we need to be early on in these discussions with our clients about, who's your end consumer, who are the investors, are they going to be accredited, are they going to be higher than that? How can we structure this to avoid, hopefully, the 40 Act, avoid the Advisors Act, avoid Exchange Act registration, which we talked about previously, and comply with some of the requirements, under the rules and regulations of the 33 Act. So I think we're kind of seeing here the multiple layer that you guys constantly advise on, which is great. So thanks for joining us today. If you have any questions or suggestions for future episodes, please contact us. You can visit our securities and corporate governance and our REITs web pages at williamsmullen.com. There you can find out more about our team as well as all of our legal alerts. And finally, be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening, and until next time.
This podcast contains general condensed summaries of actual legal matters, statutes, and opinions for information purposes. It is not meant to be and should not be construed as legal advice. Individuals with particular needs on specific issues should retain our services or the services of other competent counsel.